Hello, my name is Derek Afasi. I'm owner of Afasi Financial Group based out of Tampa, Florida. Today we're going to be discussing permanent life insurance. Now before you watch this video, be mindful to definitely take a glance over at the cash value of life insurance and also term life insurance. It'll help supplement a little bit about what you learn right here. Now, permanent life insurance was first developed to make sure that it pays out 100% of the time. It's equivalent to owning. Premiums that you pay towards these policies go into different sections. There's a death benefit section, there's a fees section, administrative fees, different types of fees, and then there's also a cash value section. Cash value section is a way that, and look at the cash value of life insurance, that you could accumulate some assets to supplement retirement. It comes out in a tax-free manner. But ultimately, you have to understand what your cost of insurance is going to be and what the fees associated with it are. Cost of insurance and the fees are heaviest in the first 10 years. Ultimately, with life insurance companies, they're using the law of large numbers. You're taking your premiums and you're mixing it with millions of other people. So your premiums are ultimately going to be for people that had their policies for 50, 60 years that are now dying. So in the first 10 years, it's always the heaviest because that's ultimately where they want to make sure that you're paying those fees, you're paying the cost of insurance, so that after 10 years, everybody new is going to be paying for your death benefit. The different types of crediting methods within cash value have to do with the type of policy that it's in. You have whole life, you have universal life, you have guaranteed universal life, you have variable universal life, and you have index universal life. Whole life is more like the ironclad of guarantee. So this is going to give you, it's going to guarantee that you have a death benefit there. As long as you pay your premiums, it's going to be level premiums. They're not going to increase or decrease. They're going to be level. As long as you pay your premiums and you don't try to take any money from the policy, no cash value, you're going to have a death benefit. Your cash value will accumulate on a guaranteed rate of return depending upon the company. The way that they pay out their interest credit for the cash value is based off of something called dividends. It just basically return a premium. They understand, okay, you put X amount to death benefit, depending on how many people pass away that year. If it was a lot less than what they determined, and they'll give you a little bit of an interest credit called a dividend. The dividends, obviously, because of the different fees, they're not going to be as high within the first 10 years as after you really start to roll in regards to the cash value. The interest credits can accumulate more and more and more because the fees are going to be cheaper and cheaper. That's whole life. It's very conservative, very guaranteed, and it just gives you a death benefit, and it also gives you a little bit of cash value. If you ever come into a circumstance, you could borrow from that cash value. But majority of the whole life insurance companies tell you, oh no, it's tax-free money. You could go, you could take this money. It's not a problem. Everything's tax-free. There's no problems about it. But they hit you up with loan rates. So you want to look for the companies and give us a call as well. We'll help you out find which companies would be most useful to your situation so that you're not paying 8% loan rates and saying, okay, well, you told me it was going to be tax-free, but yet I have to pay a loan rate. And when you are paying this loan rate, the dividend stops. So there's different types of nuances out there, different types of sweet spots regarding the company. You have a universal life. Now, these were very, very attractive in the 1980s. Why? Because this is tied to something called interest rates. In the 1980s, interest rates were in double-digit figures. So what they would say is, hey, we're going to make, your cash value is going to be tied to interest rates that are paying 15, 18%. The economy is great right now. We're going to keep this. It's going to be great. Interest rates are never going to go down. Cash value is just going to keep increasing. So the cash value is ultimately what keeps the death benefit in force. So if you're putting money in and you're expecting an 18% return, you could put a lot less premium in there. So we'll say, okay, maybe you have $100,000 of life insurance. Based on an 18% return, you could just put 40 bucks into the policy. It's fine. Just pay it every year. We're going to 18% returns, but it's all illustrative purposes. So that 18% was never guaranteed because it's tied to whatever interest rates are. Right now, they're in single-digit figures. They could be 2, 3%. And that's a good thing. Everybody sees right now what CD rates are right now. So ultimately, because people kept underfunding these policies, when it came time, the death benefit has an annual renewable term associated with it. So every year, as I talked about in the term video, the cost of insurance is going to increase, 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 increase. So the only way that these policies work is if you overfund majority of it. So say year one, you're 30 years old, and the cost of insurance for that annual renewable term is $10, you should be putting in $200. $200. So even though this is ticking up every year that you get older, the cost of insurance is going to get older. It doesn't catch up to you when you hit your 50s, your 60s. That's universal life. A lot of people sold it the wrong way because they would put their illustrative purposes, and they didn't know. Nobody had any idea that the interest rates were going to be so low. But ultimately, they'd illustrate it at 18% projections, and then now when it comes time, when people are 60 years old, they underfund these policies so much because they expected such a high rate of return with the cash value. Now these policies are quote-unquote blowing up. So people getting notices in the mail that say, okay, just keep your policy in force for this next year because it's annual renewable term. That's what the death benefit's associated with. It's going to be $6,000, but yet they're paying $40 a month. So there's different things in regards to that. In the late 90s, early 2000s, they came out with something called the GUL. It's a guaranteed universal life. They understand, these companies understand that the universal life, that the interest rates were so horrible, but some people just wanted to have permanent coverage. They didn't care about what the cash value would be. So they wanted something that kind of emulated a permanent term. So that's how a guaranteed universal life came about. It's basically a waiver. It's an additional rider that comes attached to the policy. So we understand, they say, we're going to make a determination of exactly how old you are, however long we're going to put you on the hook, but the cash value growth is going to be tied to interest rates, and we know interest rates are so low right now that we're ultimately, you don't care about that cash value. So once the cash value goes to zero, in a universal life, the death benefit you'd have to owe this enormous amount of money to basically keep this policy in force. As the cash value goes down to zero, the people don't have that money, don't have that extra thousands and thousands of dollars. So what they did was they attached that secondary rider. You put your money in, once the cash value hits zero, rather than have the death benefit lapse and have those people owe the extra premium, that's where the guaranteed basically takes in. So it has the same concept as a guaranteed term. It's equivalent to a term insurance that goes to age 121 because you don't really care about cash value. Like I said before, cash value does cost money. So you want to make sure that you're at least getting it for the death benefit and you're at least going to be covered. And this is a lot cheaper, a lot more inexpensive way on how you could properly plan. If you want to make sure that you're constantly leaving a legacy and that's most important to you and you don't care about cash value growth, the GUL is by far the most attractive right now. And there's a bunch of different companies out there. Some have certain niches. If you're a smoker, if you have diabetes, whatever that is. Just like all these different plans. That's a GUL. A VUL acts the same as a whole life, except for rather than have it tied to dividend rates, which is just the company in particular, they tie it to mutual funds. So you could have thousands of different companies. It could be a mixture of stocks and bonds. Now that cash value could increase when the market's good, but it could also decrease when the market's bad. So you run the risk of, if you're underfunding these policies, that it could come time where if you have a bad year and your cash value went really down, that they could come to you and say, you owe us this amount of money. So it's very risky. Then you have something called an IUL, which is equivalent to that whole life, to that VUL, except for it's tied into something that mimics an index. So what they say is, okay, say the S&P does well, they take a snapshot of it during that year, and what they do, how they make their money is they basically cap you. So they say, okay, the S&P gained 20% this year. We're going to make sure that you gain 15%. But what this gives you is steady, consistent growth, because if the S&P dropped, it's like a VUL, whatever the funds were, if they dropped, the cash value goes with it. In an IUL, if the funds, the S&P drops, you're still going to gain 1%. So we have a ceiling and we have a floor, but ultimately, you're going to stay consistent within that realm. So it's going to pay out better than what majority of whole lives are paying right now. And also when you want to take that money, you have zero net loans. So you might have something that's a loan rate of 3%, but they're going to give you a credit of 3%, so it's called a wash loan. Give us a call. That's just a breakdown of the different types of permanent life insurance there is out there. Depending on your situation, depending on your risk tolerance, depending on exactly what you like, we could set up a plan for you. We could help educate you. I could go on for hours and hours about each individual type, but ultimately, give us a call. We can see exactly what is most important to you. You remember, your situation is going to be different from everyone else's. You're going to have family goals. You're going to have financial goals. You're going to have occupational goals. And just to get help, give us a call on our toll-free number. You can contact us via email. You could do video conferencing if you want to see our faces. And that is basically it. This is permanent life insurance, and we'll mold a situation to your plan. My name is Derek Afasi. Thank you very much.